Okay folks, I'm going to take you through the PowerPoint slideshow of Chapter 1 of your textbook. And you really have two options here. You could either read the chapter if you tend to learn more from reading a written word, or you can listen to this PowerPoint slideshow and you'll see some of this information, well actually all the information will be repeated in your textbook, but maybe the thing to do is you do the PowerPoint show first and then read, or read and then look at the PowerPoint show. Either way, I want you to do those things prior to working the comprehensive problem, because you're going to find that the comprehensive problem reinforces and illustrates what we're going to talk about here as we go through these slides. Okay, accounting for investments in other corporations' securities. You know, you are a single corporation here and you're going to own stock in another corporate entity. Okay, now when that happens, there are really three ways to account for it, and which one of these three ways you choose, or actually that you must use, depends on what percentage of that ownership that you have. What percentage of that other entity do you own? And we'll talk about each of the three in the next slide. So the first we'll do is the fair value method. Under the fair value method, you use this when you have a small percentage of ownership, and usually that means less than 20%. And it also encompasses the idea that you cannot significantly affect that other company, or we'll call that other company the investee. You can't significantly affect their operations. Now, and these kinds of investments are made in anticipation of gaining dividends or having an accretion of value and an appreciation in the market value. And so it's a good way to use corporate cash as opposed to stuffing it into a mattress or just leaving it in a drawer. You might as well be earning a return. So that's what you do, is buy these investments on the open market. Now, the fair value method should have been covered in detail in your intermediate accounting course. Now, we won't spend any real time on the fair value method in advanced accounting, but at least it behooves us to glance back at it to remember what it was all about. And what you may recall is you'll have the securities not bifurcated. Actually, there are three different buckets you can put them in. One was trading securities, the other was the available for sale securities, and the final category, which we won't talk about here, but those were the held to maturity securities. And obviously, held to maturity means there is a finite life, and so we're talking about debt instruments in that sense, bonds being the prime example. So equity securities, i.e. common stock or preferred stock, do not belong in the held to maturity category, and so hence we're only talking about trading and available for sale. Now, the accounting for these kinds of ownerships, again, we're less than 20%, somewhere north of 0% ownership in that investee and somewhere south of 20%, and we cannot exercise significant influence. And the accounting had a mark-to-market feature, and you had unrealized holding gains or losses. So as you own this stock, it either goes up or goes down in value. And depending on whether it was an available for sale or a trading security, that determined where you recorded that unrealized holding gain or loss. And the other comprehensive income was an equity section that was, again, used for available for sale. Now, the debits and credits of this were fairly straightforward. You record the investment at cost. The investor records the investment at cost. And the simple debit and credit there is just debiting your asset called the investment account and then crediting cash or whatever the method of payment there was. And then step two was as you are paid dividends from that investee, you just simply recognize dividend income by debiting cash and then crediting an income account from that investment. Now, on the fair value adjustment, remember we had the trading and the available for sale, and if you had the fair market value exceeding cost, then you would have an unrealized gain on the investment. And this footnote here means if it is a trading security, you're going to include it in the income statement, and if not, then it's going to go to the OCI, the other comprehensive income. Now, the equity method, that's that second method. Okay, so we've already really breezed past the fair value method, and again, that was heavily covered in intermediate accounting. And so now we're going to spend a fair bit of time on equity method as we move through the slides. And certainly chapter 1 of your text is focused almost entirely on the equity method. So when do we use it? The guideline is between 20 and 50% ownership, where the investor has between that range of ownership in the investee. And there also is an element of significant influence, and you could have that present between investor and investee, which would indicate you need to go with the equity method. This slide basically says there is convergence, similarity between the international standards and then what the FASB, the Financial Accounting Standard Board, which is a promulgator of U.S. GAAP, that there really isn't that much of a difference between the criteria for the equity method. And you can see again that 20% threshold shows up. And you can read this slide for yourself, and the book discusses this also. So what is significant influence? The Accounting Standards Codification, ASC, topic 323 gives a pretty good discussion on this. And they mention elements that should be present or that are likely indicators when you do have a significant influence going on. One would be representation on the board of directors. Maybe you participate in the policy-making process of the investee. Material intra-entity transactions. We talk about these in the comprehensive problem that we are going to have as a separate video. And you have intra-entity means just between the two entities, and if it's investor to the investee, it's a downstream, and then conversely, if the investee is selling to the investor, it's an upstream. And we'll have a separate slide on that in a minute. But you'll have also potential interchange of managerial personnel. Maybe you'll have as a member of the C-suite that serves on both entities. C-suite meaning the chief this or that, chief executive officer, chief financial officer, chief operations officer, and so forth. And maybe there's mutual dependency on technological IT items or systems. And then other investor ownership percentages. Actually, in the real world, for me, I work for a company where our CEO actually is a 99% owner of an outside entity. And with that kind of significant influence, and there is major intra-entity transactions, we actually consolidate that other entity. So it's beyond just an equity method, it's actually a true consolidation. So, what is consolidation? Well, obviously, you're not talking between 20 and 50%. Now you're north of 50% ownership, where the investor has a majority percentage of the stock, of the outstanding stock of that investee. Now there's an except when if there is no real control element going on where the majority investor doesn't have it, then you probably won't do consolidations. But normally you'll find cases where this 50% ownership of their stock does have what comes along with that is a really strong control element. Now, what are consolidations all about? They are about taking several entities, however many of those entities those are, the investor and then the myriad investees where they own stock in them, and then bringing them together to present it as a single entity. Now, your book and any advanced accounting book that I've ever either taught from or learned from approaches it this way. They spend a chunk, several chapters, describing and outlining and going through all the methodology of doing these consolidations. And it is not an easy thing. And thankfully for Chapter 1, we don't have to worry about it yet other than introducing the concept. Chapter 1 is all about the equity method. And then chapters 2 through 5 of your text are where we're going to grapple with consolidations. Now, the codification section 810 talks about variable interest entities, and VIEs are something that came about as a result of Sarbanes-Oxley, the legislation that was enacted by Congress in 2002. And actually, they didn't specifically mention VIEs. Excuse me, I meant to go back a slide here. See if I can head back one slide. I apologize for that. VIEs are really actually, I mean, the FASB has defined that, but the reason that came about was because of all the shenanigans that really was the impetus for Congress reacting with Sarbanes-Oxley and that legislation in 2002. But the point being that on a variable interest entity, you would have to consolidate that even if you didn't meet the criteria of the stock ownership. Now, what companies have done for years, for decades, they will create what was called SPEs or special purpose entities, and there are just myriad reasons why a company would formulate a special purpose entity. And one of the more devious or dubious reasons that was being done by companies in all the financial reporting scandals of early 2000 or the late 90s. They would transfer risk or transfer debt, things that made the consolidated financial statements look bad or would mislead investors. They were out there parked on these special entities, special purpose entities, and therefore weren't disclosed. And the reason they could do that is up until that time there wasn't a specific requirement on consolidation, because you could hide behind the fact that maybe you didn't own a majority of the stock. But of course what was happening is you had significant control through contractual relationships, etc. So the book rightfully spends time on this as a special topic in a later chapter once we get through all the consolidations. But the thing to know now is that the SPEs, or a variable interest entity, does need to get consolidated. Now this is a pretty good slide that shows these percentages we've been talking about. Again, from 0 to 20, you don't really have the influence going on, and hence you're at the fair value. Again, that's the trading available for sale securities that you're accounting for it fairly straightforwardly as a fair value investment. Now, the equity method of accounting for an investment is when you're in between the 20 and 50%, and then consolidated statements again are required when you are north of 50%. And again, we're talking about the mechanics of the accounting that the investor must go through on their books to track these investments in the investee corporations. Okay. Some general guidelines between or among the fair value method, the equity method, or the consolidated set of financial statements. Again, you're going to record this investment at cost under fair value, and then the dividends are very straightforward. Again, I apologize for jumping ahead on my slides here, but going back, the dividends that we see here is a very straightforward debit to cash, credit to dividend income. And of course we have to mark the investment to market as we go through time. Now under the equity method, you're going to do this initially you're going to what is your cost in this investment. So that's the same. You're going to debit this investment account, this asset account on your balance sheet, and you'll credit cash or whatever your method of payment is, and that's your initial cost. Now as you go through time, that's what steps 2 and 3 are about here. You're going to have, think of it as a mirror image, that asset on your books, the investor's books, you're going to reflect what is going on inside that investee. And so that investee, its book value will increase when you have net income. Consequently, its book value will decrease if you have dividends. Okay, when there's a distribution of dividends, and that's one of these key differences here, is as the dividends are paid, and so the investor is going to get its respective share of that dividend that's being paid by the investee. What that then does is serves to reduce that investment account, because what's happening is the book value, because that investee is paying a dividend, the book value is shrinking, okay? And so as the investor, when I own between 20 and 50%, I have to reflect that shrinkage of my investment account, okay, because there's an underlying book value of that investee that's shrinking because they're paying dividends. So all I'm doing here then is recording the cash, the dividend cash that comes in as a debit to cash, but then I'll credit that investment account. Step 2 is talking about I need to reflect on my books as the investor my percentage of the ownership in that net income or net loss of that investee. Okay, and we're going to get into this on the comprehensive problem for Chapter 1. And we've already mentioned on consolidations, we're basically putting everything together as if we're reporting on one single entity. So how do we apply this equity method? Okay, we talked about we're going to debit this investment account and then credit for cash or whatever we're issuing to acquire these shares of stock. Again, we're between 20 and 50% is what we're going to illustrate under the equity method. And as that investee earns income, I'm going to increase or debit my investment account, and I'll credit this account called equity and investee income. Now, this account is what I'll call a P&L. That's P for profit, L for loss, and then so think P and then the ampersand symbol, P and L, and that's a common way to describe the income statement. You'll hear P&L statement in business a lot, so don't get confused. It's the same thing as the income statement. And this is like would be like an other income category on your income statement. So that's why we're crediting it, and that serves to give us net income. Okay. Now, if there's a net loss on the investee, what's going to happen? I'm debiting this P&L account called equity and investee income. That's going to behave like an expense. Okay, it's going to reduce my net income as the investor. And then I'm also, the credit side of that entry is a reduction to the investment account. Again, mentally think on the investor's books that investment account is functioning like a mirror image of that fractional share, that between 20 and 50% share that I own of the investee. And we had mentioned that if dividends are paid by the investee, that as an investor, I'm going to receive my fractional share of that. So if I'm a 40% owner and the dividends are $100,000, obviously I'm going to get $40,000 of dividends. The point being, as an investor, I'll debit the cash for the $40,000, but my credit is to the investment account. It's not going to be a credit to dividend income. And we illustrate the debit and credit right here. Debit cash and credit the investment. Now, what's popping onto your screen right now are just special situations. Anyway, there are four particular special situations that we're going to talk about on the following slides. And you'll also, on at least a couple of these, we're going to have that in our comprehensive problem. So the first one is if you change to the equity method. Let's say you had a smaller percentage and then you bought a big chunk of stock and it puts you over the 20% threshold. So we'll mention that. You could have a loss by the investee. Not too difficult to account for that. Reporting investee income from sources other than continuing operations, and what we're talking about would be like an extraordinary gain or loss of the investee. And again, not very difficult, but you do have to treat it a little bit differently on your entry. And then if you ever sell the equity, have a sale of the equity investment, you could sell all of it or part of it, and there's an implication based on how much you're getting rid of. Okay, if you change to the equity method. Now let's say that you were going along and you had purchased something less than 20% of the stock. So obviously you were under the fair value method up to that point. And then you bought a chunk of stock that threw you over the threshold. Now, here's what you have to do. You have to restate that investment account retroactively so that it appears as if from day one you had been applying the equity method. Okay? Now, one of the other special cases you can see in the title here was if you had income from sources other than operations. There's your discontinued operations or your extraordinary items or maybe even other comprehensive income. The point is that on your books as the investor, you are going to credit not that equity and investee income for the whole amount. If some of that came from extraordinary items, then that's what you're going to credit, is your equity interest in that extraordinary gain or loss. Now, if there is a loss by that investee, remember, what do? We're going to reflect our proportionate share. Again, my apologies. We're going to reflect our proportionate share of that loss by reducing the investment account. Okay, and then that'll be a credit, and then the debit will be to our equity share in that loss of the investee. If there's a permanent decline in their fair value, then we'll record this impairment, okay, by debiting an impairment loss and crediting the investment account. And if there's a temporary decline in the value, the underlying book value of that investee, then you just ignore that. Okay, so there's a difference here between the permanent and temporary decline. Now, if you have the unfortunate situation of the investee just having loss after loss after loss, what you don't do is you don't go below zero. So as those losses occur year over year, you bring down the investment account to reflect that proportionate share of that loss. But note that you do not, you keep it at zero until any subsequent profits that hopefully you do have a turnaround situation, and those subsequent profits then bring you back to a positive situation. But you discontinue using the equity method rather than continuing to go negative on your investment balance. Again, remember, we're talking about the books of the investor here. The excess of cost over book value. Well, at this stage in your accounting career, or your accounting knowledge, I should say, is you've realized that much of the balance sheet is at historical cost. Now, obviously, the FASB grapples with market values and how to get the balance sheet more reflective of current market value when it's appropriate to do so. But you will have, and then when there is a sale of a large percentage of the company, and if you're going to go in and buy something between 20 and 50% of the outstanding stock of some company, you're obviously going to take a very hard look at them. And yes, you do want to see that historical balance sheet. Hopefully it's going to be an audited set of financial statements that you're looking at, but you're going to be cognizant that those are based on cost, okay, or excuse me, on the book value, which is historical cost. Now, when your cost, this is the investor, what the investor is willing to pay for that percentage of ownership, you're going to say, is that greater than the book value of what I'm buying? So you're going to look at the receivables. You're going to look at the inventory. You're going to look at the fixed assets if it's capital intensive, of course, and you're going to say, what is the book value, cost minus accumulated depreciation for fixed assets, and you're going to say, is the market value of those assets greater, equal to, or less than the book value? So you do have to identify a difference. Again, this cost here is talking about the investor's cost that they're paying to gain this percentage ownership of stock in this investee. Now, and this is stating the obvious, that the fair values of some assets and liabilities can differ, and some of them differ greatly from the book value. And now, why would an investor be willing to pay extra for these assets that they're going to get a share of? They're going to buy 40% of the stock, and so buying that much of the common stock therefore gives them a ownership interest in those assets. Well, obviously they feel like there's going to be future benefit of cash flows. Because of the going concern of the business, the brand name of the business, it's got all this momentum, and you anticipate that will continue into the future and give you those future cash flows. And so as you look at that and the value that you place on that, which is really a discounted present value of those future cash flows, that could exceed your book value of the fixed assets by a very large amount. So what do you do if that cost, what you're paying for that investment, exceeds the book value? Well, you look at it, and if the assets are undervalued on the investee's books, for those identifiable assets, and I want to emphasize the word identifiable, you'll then amortize the difference, the fair value minus the book value, over the remaining useful life of those assets. So the first thing you'll do, and let's say I pay $100,000, use simple numbers, and I look at the book value of the assets, and I see that the equipment, based on my estimations, the equipment might be worth $30,000, and the book value of the equipment might be worth, say, $15,000. Well, that difference of $15,000, I would have to then amortize over the remaining life. And as I do that, it's going to reduce my investment account. And we're going to illustrate that on the comprehensive problem. So just keep that in the back of your mind. Now, let's say I can't identify any more assets where there's a difference between the cost and the book value. So then what I'm left with, I'm going to label it as goodwill. Now, the thing to know about goodwill at this point in your accounting knowledge is that you do not amortize goodwill. Okay, and so until there's a permanent decline, you just let goodwill stay on the books. Okay, so that's the thing to know about that. And we're going to get into goodwill a lot deeper when we talk about consolidations, and I'm going to give you a research project on that. And this slide just reemphasizes what I've said before, is if you paid an amount in excess of book value that you cannot allocate to any specific undervalued assets, such as inventory or such as fixed assets, then you identify it as goodwill. Now, if you sell part of an investment that you've been accounting for under the equity method, the first thing to note is you apply the equity method up until the date of the sale transaction. And then at that transaction date, the investment balance is reduced by the percentage of shares that you're selling. So maybe you own 40% and you're going to sell off 5%. So then you got to take that respective amount and reduce your investment by that, and you may have a gain or loss. And if now, are you going to lose significant influence? Now, why would I care about that? Perhaps then I may go below my threshold, and they're saying no retroactive adjustment is recorded, but you don't apply the equity method anymore. So again, simply take down your investment account for whatever it is that you're selling, but then you just stop applying the equity method. Now, this is the last of our special cases where we talk about upstream and downstream sales. Now, the thing to think about this, I mean, we've all seen streams or rivers, and so downstream is just where the investor is selling to the investee. Upstream is the flip side of that, where the investee is selling to the investor. And in your comprehensive problem, I will get into the situation where you have it's a downstream sale that we're going to illustrate, and what you're going to do, because normally there will be a profit. The investor is going to realize a profit on this sale as opposed to just selling it to them for their cost. And so if there is a profit, there is some specific accounting that we have to do. And again, I'll illustrate that on the comprehensive problem. This is the theory behind what we're going to do. Is if there's a partial stake in that inventory, then you don't consider that the earnings process is complete. The completion of the earnings process is really when you're selling the final that final amount of those goods to the outside world, something to some party that you don't have this large percentage ownership in. And so you're going to delay that profit, or the recording of that profit, until all those goods are sold in what we call here an unrelated party. Okay. Now, there are some criticisms of the equity method, that there's too much emphasis placed on just this really tight range between 20 and 50% of the voting stock, and saying, okay, that's what constitutes a significant influence or control. You can have cases where you can be between the 20 and 50% and really not have much influence. The other criticism is it does allow for some off-balance sheet financing if you say exercise that influence and then you load that investee up. Somehow they're taking on debt, and you're going to be the beneficiary of that debt. but there is an off-balance sheet risk where you're not going to be showing that on your financial statements because you're not doing a consolidation. You're going to apply the equity method, so there could be some risk that isn't reflected on your balance sheet. And the manipulation of performance ratios, again, most of the time you're talking about profitability ratios, a times interest earned, or maybe an EBITDA, which we'll get into maybe in some more advanced concepts. EBITDA is really just earnings before interest, taxes, depreciation, and amortization. And it's used in the concept of free cash flow. But I don't want to get into this last bullet because it's again just a theoretical criticism of the equity method. Now, they being FASB in 2007, let you use a fair value option. And what this is, you can make an election as an investor. You can make an election in something that you own between 20 and 50% of, and you can say, I am going to use fair value accounting on this investment. The thing to know about this is that you can't just flip back and forth. Once you do it, it's a one-time election. So once you go there, you stay there. And so obviously if you're under fair value, you're looking at what the underlying market is doing for those securities that you own. You're not really looking at the net income performance of that investee if you're under fair value. And again, this is another illustration of making that election. And if you're under fair value, changes in the fair value of the assets are reported in earnings. What this is, the fair value of the assets, that's not talking about the net income or net loss of that investee. That's talking about what those shares of stock are worth on the open market. So making an election to go fair value, just know this, that it's much easier to handle the accounting when there's a ready source of what that market value is. You certainly wouldn't want to do it in an obscure industry or where the stock isn't traded and it's closely held. Fair value is probably not a good idea. Okay, in summary, the accounting methods really fall in those three categories, and I can't stress enough that this percentage of ownership is really what we're driving home here. Is the 0 to 20 is fair value, 20 to 50 is equity method, and beyond 50 is consolidation. And we are talking about how much influence that investor can exercise over the investee. And if you pay more than book value, you're going to have the goodwill. And remember that goodwill is not amortized. But what you first have to do when your cost, what you're paying for these shares of stock, if that exceeds what you've identified as the book value, and you have specific elements of those assets, whether they be the fixed assets or whatever category it is, and you say, okay, they're undervalued by this amount of money, that's when you have to say, all right, I'll then allocate a portion of my price that I'm paying for this investment to those assets and then amortize that difference over the remaining life of the asset. Intercompany profits, the upstream and downstream sales, are deferred until it's sold to an outside party. And then here's your irrevocable election. And remember, in 2007 is when the FASB put that in place. And once you elect to go fair value on something you could otherwise report as equity, then there's no going back.